Hi again, everybody. So this is the last presentation on the idea of monetary policy. We really had two presentations that have built up to this point, looking at money and banking and looking at money creation. So this presentation, I really try and pull everything together, and we talk about interest rates and how the Fed enacts monetary policy. So we'll start by looking at the money market, which is essentially just the demand and supply for money, which will form an equilibrium, and therefore we get an equilibrium price, and the price in the money market is just the interest rate. So we'll show where the interest rate comes from, and then how the Fed can manipulate the interest rate through different tools it has at its disposal, principally something called open market operations. And then when interest rate changes, how that affects the economy. So we'll look at how the Fed essentially uses these tools, such as open market operations, to manipulate the money supply, and which tools it uses and which ones it doesn't. Once we highlight those issues, we'll be ready to go ahead and look at expansionary and restrictive monetary policy, when you'd use which and how they are used and what happens. So it's a bit like when we looked at fiscal policy. In a recession, there's a certain type of fiscal policy you want to implement and how, and if you're suffering from inflation, it's a certain fiscal policy you want to implement and again how. Well, we do the same here with monetary policy. And then we'll finish by just looking at some of the recent issues associated with monetary policy. So, to understand monetary policy, the critical component is you've got to understand interest rates, where they come from, and when they change, how they change, and then what happens next. So as I mentioned, the interest rate is simply the price of money. And so there are many different interest rates. But so we just think generically about just one interest rate. We just call it the interest rate because they all sort of move in the same direction. And so we're going to look at where the interest rate comes from. It just comes from the equilibrium in the money market. And when it changes, how that influences the economy. And we'll see, being the price of money, the interest rate is just determined by money demand and money supply. So let's look at money demand. We'll talk about money supply, and then we'll look at the equilibrium. So first of all, money demand. So think of us all as individuals. We demand money. We need money, we require money, we demand money. And there are essentially two reasons why we demand money. The first one's called transactions demand for money. We just simply need money for everyday transactions. So as you go out every day and you want to buy lunch, pick up some groceries on the way home, that's transactions demand for money. We need money. Again, money, we're talking about M1s, we're talking about notes and coins, currency in your pocket, and money you've got in your checking account. So we keep money in our checking account. So every day, if we need it, we can draw on that money and go and buy some milk on the way home or a sandwich for lunch or something like that. So this is transactions demand for money. And so, in terms of the economy, we'd expect transactions demand for money to have what we call a one-to-one correspondence with GDP. Because as GDP goes up, that's the value of goods and services, remember? So as the value of goods and services, let's say, go up, then we need more money to buy those goods. So as GDP rises, transactions demand for money will rise also. As the value of goods and services produced in the US goes up, we need more money to buy those goods and services, so transactions demand for money will rise also. Second reason for demanding money is called asset demand. So this is, I suppose, less obvious of the two, but sometimes we just like to hold money as a financial asset. So sometimes, you've got money in your checking account. Well, perhaps you're not, planning on spending that just now. So it's not really transactions demand for money. We just like to hold money as an asset in case we need it in the future. So there's an advantage and a disadvantage of doing that. So what's the disadvantage of holding money as an asset? Well, the big disadvantage is that in real terms, we are losing value. If I, as I say here, bury some money, big pile of money in my backyard, and dig it up 10 years later, then I've lost a lot of purchasing power because the price of goods goes up over time. So the real value of that money is going down. Of course, what you could have done instead of holding money as an asset is you could have invested it and claimed some level of interest. So we're losing that. We're losing the interest we could have earned had we put it in an investment account. But because we hold it in our checking account, which typically earns 0% interest, we're losing that interest that we could have otherwise have earned. So that's the big disadvantage of holding money as an asset. So the amount of money that we demand as an asset is inversely related to the interest rate, because the interest rate is the opportunity cost of asset demand. Imagine the interest rate is 0, so low it goes to 0, then there's really no disadvantage of holding money as an asset because you're not losing anything. If you invest it, you're not going to get any interest. So if the interest rate is very low, then we'd expect to see people holding more money as an asset. Conversely, if the interest rate is high, let's say 10%, then by holding as an asset and losing that interest that you could have earned had you invested it, then the opportunity cost is higher. So at a higher rate of interest, you can expect to see asset demand for money falling. So what it looks like, I want to show graphically the types of demand for money. So here we have transactions demand for money. So we're looking at how much money we want to keep to buy everyday goods and services as a function of the interest rate. And as you can see, it's a vertical line. As we said, transactions demand for money depends on the level of GDP. It is independent of the interest rate. So the amount of money I want to keep in my pocket or my checking account to buy everyday goods and services isn't a function of the interest rate, it's a function of GDP. So whatever GDP is right now, we're keeping $100 billion in transactions demand for money. And it doesn't matter if the interest rate is 0 or up here at 10%. Transactions demand for money in this example is always $100 billion. Next, though, we have the asset demand for money, and this does vary with the real interest rate, as we just described. At a high level of interest, asset demand for money will be low, again, because you'll be losing more by keeping it as an asset. But as a lower rate of interest, asset demand for money is high, again, because you'll be losing less as you keep it as an asset. So downward sloping asset demand curve to show as the interest rate falls, asset demand for money goes up. So these are our two types, transaction demand for money, asset demand for money. You add them together and we get the total demand for money. This downward sloping DM curve. So it's just the total demand for money. Again, it's a function of these two types. You can see in here, and I'll talk about in a minute, this is the supply of money curve. You can see how it's vertical. This curve is essentially set by the Fed. And so for the supply of money, as we saw there, the supply of money curve is vertical. It's set by the Fed. But we've already really discussed that process, that where does the money supply come from? Well, it's banks making loans. And so the Fed, as we're going to see in this presentation, influences how many funds the banks loan out, its excess reserves. And so it's all determined by the Fed. The supply of money is determined by the Federal Reserve Bank. So the supply of money is independent of the interest rate. In fact, the supply of money helps determine the interest rate, not the other way around. And so, as we'll see, if the Fed can get banks to, say, loan more money out, then this will increase the money supply. And therefore, that money supply curve would shift to the right. But for our purposes here, that money supply curve is set by the Fed, as the Fed controls how much money banks loan out to customers. So therefore, overall, put this all back together, you have our money demand curve, money supply curve. You can see, this is our money market right here, where demand hits supply, we get an equilibrium. And the equilibrium price, again, is the rate of interest. So here we see the interest rate in the economy will be 5%. So that's where the interest rate comes from. The interest rate is just the price of money in the money market, the intersection of demand and supply of money. So that diagram showing the demand and supply of money, setting the equilibrium, giving us the price or the interest rate in the economy, then when you think about it, if we're going to change the interest rate, then either a shift in the demand for or the supply of money curve will do that. And that's what we're going to be talking about when you think about monetary policy. Well, how can we do that? Well, the Fed, as we discussed there, controls that supply of money curve. So the Fed can indirectly manipulate the interest rate by shifting that supply of money curve. So remember, again, what is the supply of money? The supply of money is banks making loans. And the Fed indirectly controls how much money banks loan out to customers. Therefore, the Fed indirectly controls the money supply. And by changing how much money banks loan out to customers, it changes the money supply, therefore can manipulate the interest rate. So remember from earlier we said the Fed does not set the interest rate, but the Fed can manipulate the interest rate through, well, in three ways. There are three principal ways. But again, each of these three ways is just trying to change that supply of money. So the first one, and really the one that the Fed uses, the first tool of monetary policy, is called open market operations. So we'll refer to these as we go forward as OMOs, but basically open market operations refer to the Fed buying or selling government bonds or securities through transactions on the open market, which probably doesn't make that much sense right now. But let's say the Fed decides it wants to increase the money supply. And we'll see why they might want to do that in a moment. But they want to increase the supply of money into the economy. Again, what does that mean? That means they want banks to loan out more money. So how can the Fed get banks to loan out more money? Well, again, one way it can do it is through open market operations. Specifically, what the Fed would want to do is purchase or buy bonds from individuals or banks. So we'll think more about banks. So this is how the Fed can increase the money supply. It can buy bonds from the banks that hold these bonds. So if we think about this from our balance sheets that we've looked at. So here we have balance sheet at the Fed, and here's a balance sheet of a commercial banks. So if the Fed decides to buy bonds from the commercial banks, what's going to happen? Well, this is just a transaction. And what will happen is, here are the securities or the bonds. They will leave the bank, so it's a minus, and become a plus at the Fed. So these are basically, think of the securities leaving the banks, going to the Fed as the Fed buys them. Of course, in exchange, when you buy something from somebody, you have to pay. So in exchange, reserves, money leaves the Fed and is put into the bank. So this becomes a reserve now held by banks. This is increasing the reserves held by the banks. That's why if the Fed wants to increase the money supply, it should buy bonds from the banks. Because essentially what that is doing, it's transferring reserves from the Fed and putting them into the bank. Now the bank has more reserves. And from that fractional reserve banking system that we talked about, That means now the bank's excess reserves will be greater, so this bank can loan out more money. So buying bonds from banks is just a way, essentially, of getting more money into banks' reserves in exchange for these security or bonds that the bank held. So, this transaction increases the reserves held by banks, therefore increases the excess reserves held by banks, therefore increases the amount of money banks can loan out. And that is an increase in the money supply, as the banks take those increased excess reserves and loan those out to customers. The money supply in the economy is going up. Of course, this is paid for by the Fed. It's just a computer transaction, essentially, commonly referred to as printing money, even though it's not. It's just a computer transaction. But essentially, what's important, if the Fed wants to increase the money supply, it will buy bonds from the banks. Therefore, conversely, if the Fed, as we'll see later, for reasons we'll see later, if they want to decrease the money supply, reduce the money supply, what does that mean? That means get banks to loan out less money. They need to take funds away from the reserve accounts held by banks. So therefore, they would do the opposite. They would sell bonds to the banks. So we just see an opposite transaction. This time, the bonds or the securities would be bought by the banks. So the securities would go from the Fed to the bank. In return, reserves will go from the bank back to the Fed. So this is taking reserves out of the bank's reserves. So taking funds out of the bank's reserves means that the excess reserves will be less, so they'll have less money to loan out. So if the Fed wants to decrease the money supply, it should sell bonds to the banks. So the bonds go to the banks, and in return, the Fed gets the money for the bonds. So it's a way of taking money out of the bank's reserves. So selling securities or bonds to the banks takes money out of the bank's reserves, leaving less money for the banks to loan out to customers. That is a decrease in the supply of money. So that's the first thing the Fed can do. Whether they're buying or selling bonds are called open market operations. And that is the first tool and really the only tool that the Fed uses. The Fed has two other options too to change the money supply. Rarely get used, but I'm going to mention them anyway. So the second one is sometimes the Fed can loan out money to banks. It doesn't do this very often, but for example, after 9/11, when the terrorist attacks really hurt the financial institution, the Fed loaned money to banks. When they do this, they charge a level of interest, just like a bank charges you interest when the bank loans you money. The interest rate the Fed charges when it loans money to banks is called the discount rate. So, technically speaking, if the Fed wanted to increase the money supply, get banks to loan out more money, it would reduce the discount rate, lower that interest rate, tempting banks to borrow more money. Just like if a bank or in the economy the interest rates go down, it's the cost of borrowing money to us. You would think that would entice us to borrow more money. The same for banks. If the Fed reduces the discount rate, makes it cheaper for banks to borrow money from the Fed, you'd think banks would borrow more money. This would increase the amount of money they have in their reserves. So they could loan more money out to customers. Again, that's an increase in the money supply. If the Fed wanted to decrease the money supply, it would just do the opposite. It would raise the discount rate and dissuading banks from borrowing so much money from the Fed. So there's a link between the discount rate and the money supply. However, it's quite loose, as the Fed is never quite sure how the banks will react to changes in discount rate. So really, while this is a potential tool that the Fed has of manipulating the money supply, it rarely gets used. So the third option, which actually no longer gets used, but we'll talk about it anyway. The third option to manipulate the money supply is to change the reserve ratio. So if you remember, the Fed sets the reserve ratio. And again, that tells banks how much of its customers' money must stay in the bank. Well, if we change that, then that will change excess reserves. So for example, if the Fed increased the reserve ratio, that means banks must hold more of their customer money in reserves. Therefore, they'll have less to loan out. So that would decrease the money supply. And vice versa, if they decrease the reserve ratio, then banks wouldn't have to hold so much of their customer money in reserves, so would have more money to loan out, increasing the money supply. As mentioned, though, the Fed no longer uses this policy as a tool for monetary policy, and currently the reserve ratio is 10% and has been that way since 1992. But again, theoretically, it would have an effect. This table sort of shows us the magnitudes of the effects. Imagine in each case we have $20,000 here in customers' money, and we have $5,000 held at the bank's reserves. So if the reserve ratio is 10%, this bank must keep 10% of its customers' money, which would be $2,000 in reserves. That's called required reserves. If they actually have $5,000 in reserves, and this difference is what we call the excess, which would be $3,000. So based on these numbers, a 10% reserve ratio with a $20,000 checking deposits and $5,000 in reserves would create excess reserves, potential loans of $3,000. If this money was loaned out, remember this creates an overall change in the money supply of this loan times the money multiplier. Remember, the money multiplier is 1 divided by the reserve ratio, so 1 divided by 0.1 would be 10. So take the initial loan multiplied by 10 gives you the total change in the money supply. So based on these numbers, with a 10% reserve ratio, you'd create $30,000 of loans in the economy. If we make that a 20% reserve ratio, now this bank must keep 20% of this $20,000, $4,000 in reserves. We now only have excess reserves of $1,000. If that got loaned out, now the money multiplier would only be 5. 5 times 1,000 gives us the total change in the money supply of $5,000. And you can see as we keep increasing the reserve ratio, the amount loaned out is getting smaller and smaller. In fact, in this case, a 30% reserve ratio would actually, this bank would be in trouble because it would have fewer actual reserves than required. So it would have to potentially borrow money to try and make up the difference. In just a moment, I'll be really pulling this together and talking about monetary policy. But one part of this is to understand something called the federal funds rate. The Fed focuses monetary policy on the interest rate it can directly influence, and that is the federal funds rate. The federal funds rate is a rate of interest that banks charge each other on overnight loans made from temporary excess reserves. So at the end of the day, a bank might find that it has some excess reserves. Another bank might find, like in the previous example, it actually needs some reserves as it's loaned out too much money. So that bank could borrow money from another one that has some excess reserves. When that transaction happens, when one bank loans money to another, it charges that bank interest, and that interest rate is called the federal funds rate. So that's what we're seeing here. And so when this happens, we get this equilibrium interest rate in this market for bank reserves. And the equilibrium interest rate here is called the federal funds rate. So the Fed targets a rate by manipulating the supply reserves that are offered in the market, manipulating the amount of excess reserves that are held by banks. And again, they do that principally through open market operations. So the desired federal funds rate is decided by the Open Market Committee, the FOMC, who meet, and based on how the economy is doing at that moment in time and their expectations, they set the desired federal funds rate. And based on what they set, they then direct the Federal Reserve Bank of New York to undertake the open market operations required to achieve that rate. So here we have a diagram of our reserve market, where we have demand and supply for federal funds. And so we have this downward sloping demand curve for federal funds. Downward sloping because as the interest rate falls, it gives banks a greater incentive to borrow excess reserves from other banks. Supply curve for federal funds is unusually horizontal, set at the desired rate because the Fed uses the open market operations to manipulate the supply to keep it there. So essentially what the Fed is doing is manipulating this supply curve and moving it up or down along the existing demand curve to set the equilibrium interest rate at whatever it wants it to be. So if they want the federal funds rate right now to be 4%, they'll engage in open market operations to set this supply for federal funds curve right here, crossing the demand curve, giving us the 4% equilibrium rate. So, just like with fiscal policy, when the economy suffered from recession, we said the government should engage in an expansionary fiscal policy. Well, again, if you're suffering from a recession, the tool that the Fed has at its disposal is to engage in an expansionary monetary policy. Again, what they're trying to do, well, the idea is, if the economy is suffering from a recession, you're going to think that demand curve is further to the left than you want it to be. You want to increase the supply of money in the economy. You want to try and get banks to loan more money out to customers, because in turn that will lead to additional spending, which will shift the average demand curve to the right. But let's take it one step at a time. So they want to increase the supply of money in the economy. And how do they do that? Well, that's what we've been talking about by these open market operations. So first of all, the Fed may make an announcement that they're going to lower the target rate for federal funds to, say, 3.5% rather than 4%. So to do that, they have to engage in buying bonds from banks, like we talked about. Essentially, they want to get banks to loan out more money, increase the money supply. So this will increase the reserves held in the banks, or held at the banks. They could lower the discount rate, or they could lower the reserve ratio, but essentially they don't do that. When the Fed wants to engage in an expansionary monetary policy, it will buy bonds from banks. Again, as we discussed, that's going to put more money into the bank's reserves, increase their excess reserves. This is an increase in the supply of reserves, which in this case shifts down this supply curve. So now our new supply of federal funds is SF2, and that moves us along the existing demand curve, and our equilibrium is now here, which is a 3.5% federal funds rate, which was the target rate. So again, the Fed is really just manipulating where this supply for federal funds curve comes in. They increase the supply, again through buying bonds from banks. That's going to move the supply curve to here, and now we have an increase in the quantity of reserves and a lower federal funds rate. As we're increasing the number of reserves held by banks, increasing their excess reserves, again, banks will start loaning more money out. That's an increase in the money supply. Again, total money supply will increase by the original loan times the money multiplier. We'll talk here about why, therefore, other interest rates should also go down at this point. So, let's put these three diagrams up and show how this is going to play out. Here we're starting in the money market. Well, this is the diagram we developed at the beginning with the demand for money and the supply of money. Again, the Fed sets this supply of money curve. Right now I see an equilibrium price, which is the rate of interest in the economy, is 10%. So based on the current money market, we have an equilibrium interest rate of 10%. If we take that, we see at that level of interest, using the investment demand curve, we'll have $15 billion of investment spending in the economy. Now, the rate of interest should also affect consumer spending, but we're just going to concentrate on investment spending here. And based on this level of investment spending, plus C, plus G, plus XN, we have this aggregate demand curve coming in right here. Let's say right now, we know the economy is going to be here, giving us some level of GDP. Let's say it's too low. So the economy is in a recession right now. So what can we do? What monetary policy can we implement to help get the economy out of recession? Again, we're going to call it an expansionary monetary policy. What the Fed does, again, it controls the money supply. It can get banks to loan out more or less money via open market operations. It wants the money supply to go up. That is, wants banks to hold greater excess reserves, so they loan more money out. Then what they're going to do is increase the money supply. And again, that's via buying bonds from banks. That's going to increase the amount of money banks loan out. So the money supply curve here is going to shift to the right to show an increase in the money supply. Just like this. And what that does is, that lowers the equilibrium interest rate. Now it's down to 8%. And as the interest rate falls in the money market, that leads to an increase in investment spending. Again, also should lead to an increase in consumer spending. But now spending in the economy is going up, because again, the interest rate is the cost of borrowing money. So more firms are going to borrow money to buy new machinery and equipment from other firms. As that happens, we know that is going to, over now a aggregate demand, aggregate supply diagram, that's going to shift the aggregate demand curve to the right. So AD2, when investment spending is 20 billion from here, is shifted over to the right. And based on this, that's good enough to put this economy back at full employment. So the expansionary fiscal policy is the Federal Reserve increasing the money supply, lowering the interest rate in the economy, increasing spending, and shifting the aggregate demand curve to the right. If it did it again, another increase in supply of money, not that it would want to in this case, because again, that would lower the interest rate, increase spending, shift the aggregate demand curve further to the right. Now the economy would go past full employment, and we know the big effect here is that prices would go up, and this would be demand pull inflation. So based on these diagrams, the Fed wants the interest rate to be set at 8%. So when interest rates fall, this impacts the economy via shift in the aggregate demand curve. So to summarize expansionary monetary policy, the Fed enacts an expansionary monetary policy when the economy is suffering from a recession, and it begins with an increase in the money supply. And that's created by the Fed buying bonds from banks. That increases the money supply, shifts the supply of money curve to the right, that lowers the interest rate. As the interest rate falls, that's the cost of borrowing money going down. More companies and also households will borrow money and then spend it. So we should see an increase in I, but also an increase in C. And that's going to shift the aggregate demand curve to the right. As the aggregate demand curve shifts to the right, that increases equilibrium GDP and pushes the economy closer towards full employment, therefore reducing, if not offsetting totally, the recessionary gap situation. We should also see some increase in the price level now as firms increase their production to meet this increase in aggregate demand, but as long as we're still moving up towards the full employment level of output, we shouldn't see any major increase in the price level, just a very small increase in the price level, which is fine. So, really this little diagram, schematic, shows the cause-effect chain. Because as we hopefully can see now, there's quite a few steps that this flows through. And so you can see really all the steps here where we start with the problem, right? The problem is we have a recession and higher unemployment than we want. So the Fed enacts an expansionary monetary policy, essentially buys bonds from the banks. Again, it could also do these other things, but it really doesn't. It just buys bonds from banks. That increases the excess reserves held by banks, so the federal funds rate will go down and the money supply will go up. As banks loan out these extra reserves, the money supply rises. Interest rate in the economy falls via the money market. Investment spending rises. Consumer spending would rise too. Aggregate demand curve will shift to the right and real GDP will increase. That's one slide that really depicts what expansionary monetary policy is and how it works through this cause and effect chain. So you can probably imagine that if we have the other problem, inflation, where the aggregate demand curve is too far to the right, then the opposite problem requires an opposite solution. So if inflation is the problem, the Fed would want to enact a restrictive monetary policy, which is designed to shift the aggregate demand curve to the left. So we really just have to reverse everything we've talked about. When inflation is the problem, the Fed will want to decrease the supply of federal funds, reduce the quantity of these reserves in our market, so decrease the supply of federal funds, but increase the federal funds rate. Again, decrease the quantity reserves, so we've got a decrease in the money supply. And back to the money market, over here, if we decrease the money supply, let's say we were right here at SM2 and DM, let's say right now in a money market, the interest rate is 8%. If we can decrease the money supply, move it to SM1, again, that increases the real rate of interest from 8 to 10%. So this is a restrictive monetary policy, which is designed to reduce the money supply, get banks to loan less money out. And how do they do that? Well, principally by selling bonds to banks. Sell bonds to the banks. In return, the banks give the Fed money. That's taking money out of their reserves. They have less money to loan out. Therefore, the money supply decreases and the supply money curve shifts to the left, giving us a higher real rate of interest. If we take it over to our investment demand curve, as the real interest rate goes from 8% to 10%, that's reducing the amount of investment spending. So spending in the economy falls. And again, that is going to shift this aggregate demand curve to the left. So if our aggregate demand curve is too far to the right, like it would be here, then the price level will be too high. We want to shift the aggregate demand curve to the left to get the economy right here, which in this case is full employment. The Fed would want to increase the interest rate to reduce investment spending and get this aggregate demand curve here to shift to the left. This is a restrictive monetary policy. Again, we have this cause-effect chain. Everything is just reversed. The problem now is inflation. The Fed would want to sell bonds to the banks, taking money out of the banks, lowering their excess reserves, increasing the federal funds rate, so the money supply is going down. Therefore, the interest rate is rising. Investment spending and also consumer spending will be falling. The aggregate demand curve would shift to the left, and we have the effect of reducing the inflationary pressure. So that is essentially it. It's taken us some time working through the banking system to understand how monetary policy will work. But again, the overall idea, I think, is intuitive in terms of just shifting that aggregate demand curve to the left or to the right, depending on what the problem is in the first place. And it all works through manipulating the excess reserves held by banks via these open market operations. There are distinct advantages of a monetary policy over fiscal policy. Essentially, it's much quicker. The Fed can buy and sell bonds on a daily basis, so they can enact a monetary policy very quickly. They can change the interest rate in the economy very quickly compared to perhaps, say, fiscal policy when you're changing a tax rate, and that's got to go through Congress. That could take months and months and months. Open market operations can be done on a daily basis, so it's much quicker than fiscal policy. Again, though, it's also isolated from political pressure. So there's no potential advantage of enacting a certain monetary policy, let's say in an election year, where there may be potentially with a fiscal policy, which again is all about government spending and taxation. So in recent times, monetary policy has been highly active, certainly very active through the Great Recession. So the Fed responded with quick and innovative actions during the financial crisis we've talked about and the recession 2007 to 2009. Essentially, they reduced interest rates to almost zero, historically very, very low interest rates to try and stimulate spending in the economy and kickstart the economy again. Critics of the Fed would contend, though, that the Fed themselves actually contributed to the recession by, prior to the recession, keeping the federal funds rate too low for too long. Essentially, one of the big criticisms is that one of the reasons why we had this housing market bubble was interest rates were too low for too long, encouraging people to borrow too much money and, essentially, therefore, buying perhaps a second home or a home of greater value than perhaps they could afford, which caused the problem in the first place. But once we went into the Great Recession, again, the Fed really was quick to help stimulate the economy by implementing a zero interest rate policy, where really the interest rate was very close to zero. Again, designed to help try and get people to borrow more money, spend more money, and shift the aggregate demand curve to the right. When growth remained very sluggish for a long period of time, the Fed had to find a way to deal with this zero lower bound policy. Again, interest rates can't fall below, normal interest rates can't fall below zero. And so the Fed was constrained somewhat. They can only reduce interest rates so low. You can't reduce them any lower than zero. They can't become negative. So they also tried some quantitative easing, a little bit similar to open market operations. But this one is not intended to lower interest rates, but rather stimulate increased lending by the banks. Also, the Fed changed its policy of being somewhat vague about their targeted federal funds rate and how long it would last to an idea of forward commitment. And under forward commitment, the Fed engaged in pre-announcing exactly how much it was going to buy and how long the buying would last. So the Fed was very open about its strategy. Prior to that, they were deliberately vague about how long the change in the federal funds target rate would last. And the reason for doing that was because they could therefore change that rate at any time if some unexpected circumstance arose. However, that improvement in flexibility came at a cost, and the cost was some reduced credibility because the public might not react strongly to any policy change if it thought that the policy change might be reversed at any moment in time. So by pre-announcing the exact size and duration of the new policy, the Fed removed that worry. So by making this forward commitment, the public would know not only the content of the policy, but also that it wasn't going to be suddenly reversed. And this continued until what's called the Maturity Extension Program, or also called Operation Twist, that was introduced in September of 2011. And under that program, the Fed pre-announced that by the end of 2012, so over a year away, they would purchase $677 billion in long-term government bonds, while simultaneously selling an equivalent dollar amount of short-term government bonds. The motivation of the Fed from this was to increase investment and consumption by reducing long-term interest rates. Before doing that, long-term interest rates were significantly higher than short-term interest rates. So again, the idea here of this Operation Twist was designed to reduce those long-term interest rates and stimulate consumer and investment spending. There are, of course, some problems and complications. There are lags, similar to, if you recall, some problems from fiscal policy. There were three types of lag: recognition lag, administrative lag, and operational lag that we talked about. And so we have lags that complicate monetary policy too, because although it's faster than fiscal policy, there's still some delay. There's still a 3 to 6 month delay that can cause problems and end up with the Fed maybe overshooting its targets. So as the Fed acts, there's an operation lag of about 3 to 6 months. So it takes approximately 3 to 6 months before the required interest rate changes and they have their full impact on investment spending and aggregate demand and real GDP. So there's this definite operation lag effect. Economists also feel that monetary policy is more effective in controlling inflation than it is in trying to help the economy that's suffering from a recession. So as we talked about, an expansionary monetary policy, which would again create more excess reserves held at banks, doesn't necessarily mean the banks will loan the money out. So it may not have the desired effect, whereas it's thought that a restrictive monetary policy used to deal with inflation would be more successful. Ex post, so once we've gone past the recession, still very difficult to really understand which policies were successful in doing what. It's hard to disentangle the effect of the two policies when two policies are enacted at the same time. So which policies actually succeeded? Was it the expansionary fiscal policy or the expansionary monetary policy? We might never know. So, bring this whole thing together, the big picture as I'm calling it here. We have our aggregate supply side of the market as a function of our input resources and prices, the productivity that we talked about, and the legal and institutional environment, all driving the production of an economy. Then we have the demand side of the market, which is the side that we really spent more time talking about, C, I, G, and XN, that drives the aggregate demand side. And there we have this equilibrium condition that sets the level of output in the economy, employment, therefore income, and also prices. So this course of macroeconomics and macroeconomic policy is really designed to show us both sides here. But again, from our initial equation, GDP, our level of the supply side of the market, the value of production, GDP, is a function of C, I, G, and XN. So hopefully the big picture stuff is sitting with you, that these are how economies work. Production in the economy, the supply side is driven by the demand side, how much money is being spent. And that's what drives the equilibrium level of GDP, employment, income, but also the prevailing price level in the economy.